Hi everyone, thanks for joining Phillip Securities Research Morning Call. Today we have stock counter updates on Adobe, Apple, and OCBC results. And for initiation, we have CSOP, iEdge, S-REIT Leaders Index ETF, as well as OUE REIT. And for Phillip on the ground, we have with Thai Beverage. For macros and sector outlook, we have the MAG-7 monthly update, S-REIT's monthly update, as well as SG Weekly 26. As Jane is on leave today, our technical analysis, we will not be having technical analysis today. Without further ado, I'll pass my time off to Ambrish. Thank you.
Thank you, Zain, and good morning, everyone. So moving on to Adobe's second quarter results. Last week we had released a report. Next slide, please. Next slide. Thank you. So overall, the results were in line with our expectations. The first half 2024 revenue and adjusted PATMI, they came in at about 49 and 50% of our full year forecasts. In terms of performance in the second quarter, the company reported a revenue growth of about 10% year over year. And this was mainly because of higher subscription sales for its creative and document management solutions. So for a digital media segment, it basically accounts for about 75% of the total revenue. And it mainly includes its flagship products like the image editing application like Photoshop and the Acrobat PDF. Moving on to the positives, the net new digital media annualized recurring revenue, it reported about 487 million, and it grew by about 10% over the company's guidance range. And this was mainly because of higher subscriber growth and also higher average revenue per user, as the existing users, they upgraded to paid versions, mainly to access the AI capabilities like the Firefly services and the AI Acrobat and Acrobat PDF. And Document Cloud, it was the fastest growing segment, and it reported a revenue growth of about 90% year over year. And this was mainly because of continued demand for Acrobat PDF solutions and e-signature capabilities as the workflows they move digital. So secondly, the margins for Adobe, it continued to improve from about 34% the previous year to about 36% in the second quarter of 2024. And this was mainly because of high operating leverage. So for instance, the operating expenses for this quarter, it grew by about 8% as compared to 13% in the previous year. And this is mainly because of the company, it focused on measured hiring and lower sales and marketing expenses. In terms of negatives, the Creative Cloud segment, it faced pricing headwinds. So this is mainly because the net new annualized recurring revenue for Creative Cloud segment, it basically dropped by about 10% year over year. And we believe that this is mainly because of pricing headwinds. So the price increases which were done in about 2 years back, so it already hit the a majority existing base in 2023, and as a result, it has now started to roll off and it faced the pricing headwinds. In terms of outlook for the full year of 2024, Adobe expects revenue growth of about 10% year over year, and it slightly boosted its outlook for its digital media annualized recurring revenue by about 50 million, and it now expects about 1.95 billion US dollars. And this is mainly because the management, it said that it's witnessing strong demand trends for its AI-based solutions like the Firefly services, and it mainly from the large and small and medium-sized businesses. And as a result, it's expected to witness growth in its number of users, and also a higher average revenue per user as they move to the price plans. And but in the near term, we don't expect any significant contribution to its top line growth from its generative AI capabilities, and this is mainly because its company, it's currently focusing on like it's currently focusing on user engagement and not on monetization right now. And also the price increases which it had done in November 2023, we expect a modest contribution this year, mainly because it has not yet hit the existing customer base, and it should hit at the end of this year. It's beginning to hit at the end of this year as the customers, they come to the renewals. And in terms of valuations, we maintain a reduced recommendation. However, we increased our target price to $480 from $465 previously. And this is mainly because we increased the adjusted PATMI by 1%, and this to reflect the lower expenses. And overall for Adobe, we believe that the growth, it has already been priced in. And although it's witnessing strong demand trends, it needs to witness the accelerated revenue growth, mainly because the revenue growth rate over the last several quarters, it has remained constant at about 10%. And also it's witnessing increased competition from smaller peers like Canva, and also OpenAI's DALI, which can uh, perform the functions like Firefly, which can generate images from text-based prompts. And and as a result, it could impact its monetization strategy. And so overall, we maintain our reduce for Adobe. So that's all for me. Would now like to pass it on to Helena.
Thank you, Ambrish. Move on to Apple. So Apple held its annual Worldwide Developer Conference on June the 10th, where the company introduced AI, Apple Intelligence, its AI framework that supports a range of new features that can be integrated across app to perform tasks. It also reviewed updates to its software. We released a report afterwards with the title throwing its head into the AI ring. Next slide, please. So the biggest highlight of the event is obviously their review in Apple Intelligence. So Apple has been rather slow compared to their tech peers in coming up with their game plan in AI. And they finally have not disappointed us. They came out with an entire series of updates in AI. So I focus on the following few points. The first is the AI-centric upgrade on Siri. So Siri is becoming smarter, more natural, relevant, and personal. Their updates include, first, it can respond to conversational language. The second, it has the ability to cross-reference information to perform action across apps. For example, if your friends send you an invitation to a concert, it will cross-check with your calendar to see whether you're available. It will also cross-check with your the Google Map to check the traffic information to determine whether you can make it on time. The third is it can summarize text in emails and other apps. It has AI writing tools that helps you to rewrite and adjust the tone of your writing. So this is similar as the ChatGPT ways. And also, like when they summarize the point of your mail, it will appear like in the preview, so it will be easier for you to screen through which is the important mail. The last one is they also prioritize notifications, so they will surface the ones that require the most immediate attention. They also came up, the second one is the image creation features. So they have generative AI being introduced into image creation, offering features such as a Gemoji, which is a generative emoji. So they allow you to create customized emojis, so you can see the picture there. If you type in a squirrel DJ, it will automatically synthesize a picture of a squirrel being a DJ. They also came up with image playground for generating new images across various apps, which is the other picture on the right. So you just need to type in what you want the picture to be. It will automatically come up with the picture yourself. The third is advanced search capabilities for videos and photos. So in case you wanted to search for a photo, but you don't exactly remember when it was taken, you just need to search like, oh, it was a video about bubbles. So they will automatically search it for you. The last one is similar to other like Google or Huawei, is the new photo editing tools, which is like cleanup tools. So you can clean out irrelevant people in the background. Next one they wanted to focus on is AI privacy. So Apple emphasizes its commitment to protect their user data. They promise that users will have more control over their data because most tasks will be run on the device itself. Apple's private cloud compute data center will handle more complex tasks when it requires greater processing power, but Apple itself will not have access to this data. We believe Apple's privacy-focused entry into the AI arms race could serve as a significant differentiator from its primarily cloud-based rival, because first, Apple has long been recognized as one of the Silicon Valley's most private and secure conscious company. And second is because unlike most of its competitors, such as Alphabet, Meta, and Amazon, Apple's profit come from hardware sales and services. So they're not really dependent on collecting user data. They have also announced their collaboration with ChatGPT. So ChatGPT will be directly integrated across the system to handle more complex text. Permission will be asked before any data is sent to ChatGPT. They also mentioned that there will be integration with more third-party AIM in the future. Last I wanted to mention is the AI new features will only be available on selective hardware because the high workload of Apple Intelligence, they will require the support of chips with higher computing power, which is A17 Pro and M series chips. So you can see from the table, these are the ones that support Apple Intelligence. So basically all the new iPad and Mac do support, but for iPhone, it's only iPhone 15 Pro and 15 Pro Max that supports it. Okay, moving on to the next slide. These are the operating system updates. So the usual, the iOS 18 updates. The worth mentioning one is they allow more customization. So you can rearrange and change the color of the apps and widgets. They also introduce text effects for iMessages and easier organization of the photo album. For the iPad, the worth mentioning one is they include a feature of calculating app with math notes, which allow users to write out the mathematical expression and see them solve in their own handwriting. For the MacBook, the new feature include iPhone mirroring, which enables full access to control your iPhone directly from Mac. And there's another one called Safari Highlights, which makes information discovery while browsing easier. So basically, when you open a website and you wanted to know what music was playing in the background, they will already have the information for you to directly click on. For the watch operating system 11, the new feature include the ability to measure train load. They also support pregnancy, and they have a customizable activity ring for you to better manage your health. We believe the above announced features will likely trigger a new round of hardware upgrades, especially in iPhone. And because we see from the table there, only iPhone 15 Pro and Pro Max support the new AI features. So this is definitely going to prompt consumers to replace their older device with the latest models, driving iPhone demand. Additionally, we're seeing the convenience and efficiency offered by the integrated ecosystem when using multiple Apple devices together will likely lead users to invest in multiple Apple products, thus increasing the number of devices per user. In terms of our recommendation, we downgrade to a neutral rating from Accumulate. This is after considering the recent share price movement. We increased our target price to $220 from $194. We raised our iPhone unit estimate by 8% and increased our FY24 revenue and PATMI by 5% and 3% respectively to account for the higher upgrade demand for the products. So that is all for Apple. I'll move on to my next coverage, which is the CSOP iEdge S-REIT Leaders Index ETF. So we issued a report with the name the Deeper Discounted Singapore REIT ETF. So some introduction. Next slide, please. So a little bit background of the ETF. This ETF provides investors with exposure to a diversified portfolio of REIT listed across Singapore. Their benchmark index is iEdge S-REIT Leaders Index. So the ETF is established in 2021 with 22 securities with a market cap of 70 million Singapore dollars. It is one of the only two REIT ETF listed on SGX that's focusing solely on Singapore. So a few investment merit. The first is obviously convenient and efficient way to access the REIT market. The second is sustainable income over the years. So you see the DPU graph on the right. Ever since its introduction in 2021, the DPU has been slowly, stably climbing from 25 cents all the way to around 55 cents now. So it's definitely sustainable income. And its book value is becoming more attractive over the last 2 years. We see the graph on the right, the book value per share. So right now it's actually lower than one standard deviation below average. So it's definitely a very attractive value point. Moving on to the next slide, we will talk about the valuation methodology. So we have shared this earlier with regard to the other REIT ETF. We'll be using the same methodology. So we basically use two different valuation methods. One is where we use dividend yield spread. The other is we use the PB ratio. For dividend yield spread, we're using the spread to 10-year bond. And the PB ratio, we're calculating the PB ratio using the weighted average of PB ratio of its individual components. So in the end, we use sensitivity analysis to apply 5% and 10% discount and premium to come up with a range of our valuation. After we came up with the target price using these two separate methods, we take 50-50 weightage and came up with a final target price of 87 cents. Moving on to the outlook. We think dividends from REIT will still remain pressure from higher interest rate. But in contrast, we do see that property valuation in Singapore have been stable, supported by transaction prices. We think interest rate cuts can provide REITs the triple benefit of a yield more attractive to bond, lower interest expenses, and increase valuation as cap rates compress. That would be all from me. Now I'll pass my time to Jonathan to talk about Magnificent 7.
Yeah, thanks, Helena, and good morning, everyone. Yeah, so I'll just do our quick recap of our MAG-7 monthly for the month of May. Next slide, please. Yeah, so overall, the MAG-7 had a really good month. It's actually the best month of the year. They're up almost 10%. This is basically double the S&P 500's gain, which is a significant outperformance. Most of this was led by NVIDIA. Obviously, they were up 25%, mainly due to their outperformance over their first quarter fiscal year 2025 earnings. Basically, all the companies were positive except for Tesla, which is the main laggard. They're down almost 3% due to continued disruption or production disruptions in their Berlin factory, as well as production cuts of their Model Y in China. Next slide, please. Just a kind of comparison, just to show the impact of Magnificent 7 stocks. Year to date is as of 31st of May, so not as of yesterday or the week last week. So essentially, the MAG-7 is up about 20%, double the S&P 500. If you remove these MAG-7 companies from the S&P 500, it basically takes away half the gains of all the other 494 companies. I think there's 501 companies in S&P 500. But yeah, essentially, it just kind of puts into perspective the significance of the MAG-7, especially as they continue to grow in size and market cap. Next slide, please. Moving to just some of the news. For Meta, not so much, no significant news, except they had a very strong rebound after this kind of 12% dip post-earnings. In terms of pricing for ads, this continues to grow, reaffirming our thesis of a recovery in the digital advertising industry. Just for some context, ad prices actually hasn't really been growing through for over 2022 and 2023. Ad prices were actually declining constantly. So it's a good sign that ad prices actually are starting to grow. I think this is the second consecutive quarter already. Meta should also really benefit from increasing spending, increasing political campaign spending leading up to the US elections they won this year. For Alphabet, they also unveiled their new 6th gen TPU chips. So essentially just an upgrade over their 5th gen. And they use this TPU chip specifically for in matrix processing for a lot of their AI models and inferencing. So like every other upgrade, it's more efficient, more powerful, and can do more processing. Yeah, for at least for their own AI infrastructure. They also plan to invest about $2 billion in data centers and a cloud hub in Asia. This will be in a business park in Selangor, which is good news for the country. It will provide about 26,000 new jobs by 2030. Also in line with Alphabet's and other hyperscalers' commitment to expanding their cloud or data center footprint. So for NVIDIA, like I mentioned earlier, I did a report about this a couple of weeks ago. They topped their first quarter earnings expectations, both on the top line and bottom line, mainly due to a higher ramp up in their GPU supply. So for NVIDIA, they are really only constrained by supply because demand, at least for right now, is extremely robust. There's a lot of people, customers demanding their new products. So that's driving a lot of the revenue growth. So as long as they can continue to ramp supply at a fast rate, it's definitely a benefit both the top line and bottom line. They also announced a quarterly dividend. They increased their quarterly dividend by about 150%. And they announced a 10-for-1 stock split, which has already taken place, I believe it was 7th of June. So our target price has actually been changed from 1,400 to 140, and we just divided by 10 based on the stock split. For Tesla, like I mentioned earlier, there's another shutdown in the Giga Berlin factory. So they're suspending production for 4 days, which is quite significant when it comes to just overall production, mainly due to a planned protest against the factory's expansion. So Tesla is actually trying to expand the factory to other parts of, I guess, just expanding it. And there's a lot of activists that are against it. I'm not exactly sure why, but when they do these planned protests, Tesla has no choice but to shut the production down, shut the plant down. Sorry. They also lowered the output of their Model Y in China by more than 20% so far in the second quarter. If you just look at April's production numbers, it's 33% down year on year, which is significant decreases in production. And it's a little bit concerning because at this rate, we're not sure if Tesla will be able to grow volume production for 2024 compared to 2023. You compound this with price cuts, then it's just really not a good environment for Tesla overall. So we still have a reduced call on Tesla. So that's all for me. I'll hand it back to Helena to do Apple and Amazon. Thank you.
Okay. So do note this report actually came out before the WWDC, so our recommendation for Apple hasn't changed yet. So that time Apple is offering further iPhone discount in China amidst the rising competition. So they're providing discount exceeding more than $300 on specific iPhone models in China. Because the company's share in smartphone market in China has been declining, slipping to the third place in the first quarter. So they are trying to promote their sales. Resellers in China have already reduced the price of iPhone 15 device by $180 in February. But that doesn't seem to be working, so they have increased the discount to $300 now. So the recent price cut in April has increased their iPhone shipment in China to surge by 52% month on month. Another news is that Apple is opening first retail store in Malaysia in June. So this is definitely their strategy to strengthen its presence in Southeast Asia to kind of diversify away from the reliance in China. Their CEO's recent tour to Southeast Asia, including visits to Vietnam, Indonesia, and Singapore, also signals the same effort in the region. We think Apple has long relied on the Chinese market and iPhone sales for growth. The recent discount represents its continued attempt to try to regain market share in China. However, such discounts are unlikely to be sustainable for Apple, who has long adopted a high-profile, no-discount sales strategy that maintains its image in the high-end phone market. So we don't think the discount is going to be a long-term thing. Apple, as a result, is also actively seeking to diversify into new regions like Southeast Asia to reduce its dependence on China. Moving on to Amazon. So Amazon plans to invest around $40 billion to boost cloud infrastructure worldwide. So Amazon is significantly expanding its cloud infrastructure on a global scale. These investments encompass $9 billion in Singapore, $1 billion in France, $8 billion in Germany, $17 billion in Spain, and several billion in Italy. So these initiatives does align closely with the management's strategy to invest heavily in AWS to meet the escalating demand. But we think they have been expanding its investment to boost the AWS for quite some time now. And they did mention in their previous announcement that they're going to increase the CapEx. But the reason notable uptick in the investment frequency still came as a pleasant surprise. We see this as a very highly positive indication of AWS reacceleration. Because if you take a look at the capex of Amazon in FY 2023, it only totaled $48.4 billion for the entire year. So if this month they announced $40 billion already, that's definitely a pleasant surprise. So we maintain our buy recommendation on Amazon with a target price of $220. Now I pass my time to Ambrish to close off with Microsoft.
Thank you, Helena. So moving on to Microsoft, in May, they had announced that they would be introducing Copilot Plus PCs with AI features. So these new Copilot Plus PCs, it introduced its latest version of a Surface laptop and Pro tablet, and they are powered by Qualcomm's Snapdragon X Lite and X Plus processors. So these personal computers, they would also be having an upgraded version of Windows 11. And they are expected to run the AI tasks on devices and with no dependency on cloud. And the number of tasks, like the main features for the AI tasks would be that they have the ability to translate audios from 40+ languages into English captions live. And also users, they can generate AI-based images from text through text-based prompt, through Paint from text-based prompts, and also edit them. And also the Copilot Plus PCs, they would after a few seconds they would take a screenshot, or they would create a log of screenshots, and through that screenshots users can have a recall feature of what they were previously looking for. And the pricing for the Copilot Plus PCs is they would be starting at $999, and the company it started shipping in the previous week. And currently, these Copilot Plus PCs, they would be powered by Qualcomm's processors, and also the OEMs like the Intel, Asus, and Dell, HP. They would be also selling these Copilot Plus PCs based on the Qualcomm's processors. And in future, Microsoft plans to introduce these through the AMD and Intel processors. But overall, we believe that this can lead to a upgrade cycle in the personal computers, mainly because of the new hardware capabilities, as they are more efficient, and they also have a longer. They also promise that they have a longer battery life for these personal computers, thereby providing enhanced user experiences. So to conclude for Magnificent 7, next slide, please. To conclude, we remain overweight on Magnificent 7 mainly because of the robust AI demand, which is still the key narrative, and also with the PC upgrade cycle that we can witness in the second half of 2024. But although like mentioned earlier, there is a big demand for iPhone, and also EV companies like Tesla, they have been facing volume and pricing pressures due to increased competition. So overall, we still remain overweight on Magnificent 7. And that's all for MAG-7. I would now like to pass it on to Glenn for OCBC.
Hey, thanks, Ambrish. Yep. So this is just a quick update on the OCBC's offer for Great Eastern Holdings. Some new information has been released, and also they released the new sort of a circular by the independent financial advisor, which is Ernst & Young. So now moving on to the next slide, this will just be a quick recap on what happened previously. So on 10th May, they did a 1.4 billion voluntary unconditional general offer, which at that time wasn't final, for the remaining 11.5% stake in Great Eastern Holdings. And their offer price at that time was $25.60. I won't dwell too much on this as I mentioned it previously. But if you look at the offer price, it was actually at a premium of above their price over embedded value, price over book value, as well as their price over earnings. So they were still giving it at a premium over the 5-year average, basically. Now, moving on to the next slide, this is just to include some of the next slide, please. Some updates as to what has changed and what has also not changed. Basically, what has not changed, the main thing is that the share price, offer price of $25.60 has been maintained. But what has changed now is that this offer is final, and they've mentioned that in their circular. Also, the closing date has been extended from 28 June to 12th of July. And also, their stake in Great Eastern has increased from 88.44% to 89.01%. And this is mainly because you include the concert parties as well as some shareholders, minority shareholders, which have accepted the offer from when they announced it to 13 June. So about they increased, by about 0.5%. So they are getting very close to that 90% threshold. A bit on this 90% mark, right, which is very important, is because if this slide still, so if it falls below, there's 10%, less than 10% of free float, then Great Eastern has to delist. But there are several scenarios which we'll speak about later. Anyway, a bit more on the independent financial advisors, Ernst & Young's report on the offer. It does state that it is not fair but reasonable. Why is it not fair and why is it reasonable? I'll go more into detail. So not fair, they're looking really more at the sort of quantitative, the financials. And so based on their, why is it not fair? Firstly, is that the offer price is below their 10-year average price over embedded value ratio, as well as below the embedded value as at 31st December. And I mean, this is one of the main things why they say it's not fair. Another reason is also because their price over embedded ratio is at a 30% discount to the current embedded value. And for why is it reasonable? Reasonable, they actually do take in a lot more factors, like qualitative factors that cannot be quantified. I think some of the factors is that the qualitative ones is mainly that the minority interest will be unable to make really much of a difference in management's decisions because they only hold such a small amount, I think 10-11%, right? So they can't really change anything. Another qualitative sort of factor they look at was that there is also risk of trading suspension of the shares if it goes above that below that 10% free float threshold, and there is also little to low likelihood of competing offers. Lastly, they also look at the offers price range, which is within the range of comparable companies. So comparable companies is taking into account all the other insurance companies, but the main big ones will be AIA, Prudential, as well as Manulife. They also look at the historical liquidity of the shares. So it's seeing that the average daily traded volume for a 10-year period is only at 0.04% of free float. Yep, so that's the main reason why Ernst & Young is saying that it's not fair, but it is still reasonable for the minority shareholders to take up this offer of $25.60. However, going on to the next slide, we'll look at the 3 different scenarios for shareholder of Great Eastern and what will happen essentially to Great Eastern as well as OCBC's offer. So the first scenario is the simplest one, and as well as the, I think, best case scenario for OCBC, which is there's compulsory acquisition. So for them to have this compulsory acquisition, more than 90%, they must basically more than 90% of the minority shareholders, so the last 11-point-something% must accept the offer of $25.60. And this will lead to OCBC having more than 98.8% ownership of Great Eastern. Hence, trading will be suspended as well as Great Eastern will be delisted. And OCBC can do a compulsory acquisition for the remaining shares. So this is, in a sense, best case scenario for OCBC where majority takes up this, 90% takes up this offer of $25.60. The second scenario, which is I think will be quite likely, is that less than 90% of these minority shareholders accept the offer of $25.60, but still a minimum of 13.5% of the shareholders accept the offer. So this will result in OCBC's stake of Great Eastern going above the 90% mark. And this importance, as I mentioned earlier, of this 90% is because the free float will drop below 10%. Hence, Great Eastern will still be, trading will be suspended and Great Eastern will be delisted. But in this case, in this scenario, second one, that OCBC will have to give an exit offer to the remaining shareholders that is deemed fair and reasonable. So what is fair and reasonable, you might ask? I mentioned earlier about Ernst & Young's statement where they say it's not fair and reasonable. What is fair and reasonable then? So they said that the fair and reasonable range will be from $28.87 to $36.19. And this is mainly based on the 10-year average of the price over embedded value ratios of comparable companies like AIA, Prudential, Manulife, to name a few, as well as the embedded value of Great Eastern as at 31st December 2023. So this range is based on these two values, $28.87 to $36.19. So in this case, I think it's very similar to what happened to Boosted when they gave firstly they gave an offer, and then the less than 90% of the minority shareholders accepted it. So they had to give an exit offer which was within what the range of being fair and reasonable. So I'm guessing my opinion is they will come in around that the low end, so $28.87, maybe $29, around that range. So the third scenario is that it will remain listed, and this is because they own less than 90% of the shares, and less than 13.5% of the minority shareholders will accept this offer. Currently, they only need, I think, less than 10% more because they're already at 89-point-something%, right? So this is so insufficient shareholders accept the offer, and their total stake is still below 90%. Then Great Eastern will continue trading and remain listed, but the share price could drop back to the pre-offer price of $18.70. So the downside will be this $18.70 where the offer doesn't get accepted, but the upside would be if they give an exit offer, it will have to be in the range of above $28.87, basically. Yeah, but I hope that's conclusive enough for existing shareholders of REITs, and it explains what are the different scenarios will happen moving forward with this. Yeah, so that's all I have for OCBC. I'll now hand it over to Mel for the REITs. Thank you.
Thank you, good. Yeah. We initiated OUE REIT. Next slide, please. Yeah, it's a diversified REIT with majority of the income in Singapore. So there's like 2 hotels, 5 office, 1 located in China, and the rest are all in Singapore. The market cap is around 1.4 billion, with the downside protected by the master lease structure. Yeah, next slide, please. So here's an overview of the asset. They own 50% of the OUE Bayfront, and the rest they all have 100% interest of it. Yeah, next slide, please. Sorry, next. So we identify 3 investment merits. Firstly is the upside potential from AEI and repositioning, with downside protected by the master lease. Hilton has just had its full contribution in FY23 after repositioning from Mandarin Orchard. It used to have a lot of like the low budget tour group, but they now focus on more of the business travelers. Especially they target towards US customers, and now they are the only Hilton under the Apple's corporate list. Thereby, RevPAR increased by 27% after rebranding. We forecast RevPAR to grow by 11% for Hilton in FY24, given the continued recovery of visitors' arrival and limited supply of the new hotels. Meanwhile, Crowne Plaza also completed AEI in October 23, but they only added additional 12 new rooms. The master lease agreement will ensure a minimum rent of 67.8 million, 67.5 million, supported the group yield about 6%. And secondly, OUE REIT managed to secure a very high rental reversion of 12% for office and 13.7% for retail in FY23. The momentum is expected to continue in FY24 at around 10%. We believe the new office supply will not place significant rental reversion pressure as the asking rate of the new supplies are higher than the office properties owned by OUE REIT. While rental reversion for Lippo Plaza may continue under pressure, we forecast around like -5% rental reversion. Given the small revenue exposure of only 7.7% for Lippo Plaza, we believe the effect for the overall portfolio will be very marginal. And lastly, OUE obtained an investment grade rating by S&P in 2023. There's a table on the right. So here's a few metrics we listed for the 9 investment grade rate in Singapore. Compared to the rest of the investment grade rate, OUE has a relatively healthy gearing of 38.8%. And they also have the highest discount of 0.43 times price to NAV. And also a very attractive dividend yield of 7.8%, which is above the average of 7.1%. And furthermore, the recent green bond issuance is at a more favorable rate of 4.1%, which is lower than the current cost of debt. In first quarter 24, it was 4.5%. And we do expect another year of interest rate headwinds, causing the DPU to decline further in FY24. Well, there will be a recovery in FY25. Yeah, next slide, please. So we would like to highlight some risk. Valuation-wise, we don't expect any material change in the year-end valuation in the face of the very resilient supply and demand in both hotel and office sector in Singapore. However, downside risk will come from Lippo Plaza, which accounted for around like 8% of the total portfolio valuation. Even assuming a 10% decline in the valuation, portfolio valuation will only decrease by 0.8%, and there will be no change in the gearing. Next is income risk. Given the muted macroeconomic outlook, we approach second half 24 with cautious due to potential budget constraints for both corporate and leisure sector. Additionally, island-wide office shuttle stock increased to 0.4 million square feet in first quarter 24, up from 0.3 million square feet in the previous quarter. And finally, acquisition risk. OUE has been eyeing acquisition for mainly hospitality sector, especially in the gateway cities such as Tokyo and Hong Kong. And given the optimistic forecast for the Asian hospitality sector and the tightened interest rate environment, valuation for the hospitality sector may remain high. Potential risk involve overpaying, prolonged acquisition timeline, and also compressed yield spread. Yeah, next slide, please. So we initiated coverage on OUE REIT with a buy recommendation and target price of 0.33 Singapore dollar. OUE REIT is trading at 0.43 times price to NAV, which is below the average S-REIT of 0.8 times. Our valuation is based on DDM, using cost of equity of 10.5% and 1% terminal growth rate. At our target price of 0.33 Singapore dollar, we value OUE REIT at FY24 dividend yield of 6%. Yeah, that's all for me. I'll hand over to Darren for the REIT monthly. Thank you.
Yeah, thanks, Mel. Yeah, so for the REIT monthly, it was for last month, it was a lackluster performance for the REITs. There are basically not much catalyst right now, so the share price also barely moved. Yeah, next slide, please. Yeah, so for this, we see the REIT index for May was down 0.4%, so that's really flat. And for the other subsectors, yeah, it just ranges from 2.8% to 1.8% positive, a negative 2.8% to 1.8% positive. So it's just a very flat month. Yeah, but year to date, we see that everything is down. Yeah, the worst hit is the overseas commercial, where the US REITs were the ones that really dragged this subsector down. Yeah, next slide, please. Yeah, so for this is a dividend yield spread. So what this means is how much REIT investors are being compensated for investing in REITs over the risk-free rate, or rather like the risk-free asset or fixed deposit, if on layman terms rather. So right now it has increased to 3.1%, and we expect this to increase over the course of the year, especially now that the Fed, the summary of economic projections is projecting like one Fed rate cut at year end, probably December, but the market is pricing in about 1 to 2 rate cuts. So as this comes to fruition, then most likely that the dividend yield spread will increase as the 10-year yield comes down. So we expect this to improve over the course of this year and next year. So yeah, right now it's still below its 10-year historical average at 3.1%. So it's now minus 1.3 times standard deviations below the mean. Yeah, next slide, please. Yeah, so next is the forward dividend yield. You can see, despite the interest rate headwinds and all of the REITs paying way more interest expense and finance costs, the forward dividend yield is still above the 10-year average, but that's mainly because of the weak share price. So the forward dividend yield is at 6.5% now. It's 0.7 times standard deviations above the mean. Yeah, so from historical perspective, that looks attractive. And the price to NAV wise also, it does look attractive, as the REITs right now, they are trading below COVID lows and it's at 0.85 times. So that is as compared to the historical average of about 1.03 times. So yeah, based on these two graphs, we see it might be a good time for REITs. Yeah, but we do know that there's a lack of catalyst, as there are still interest rate headwinds, and any probably that the interest rate cuts will just be the biggest catalyst for them. So we're just waiting for that to happen. Yeah, next slide, please. Yeah, so for the subsectors, we still favor the hospitality subsector. So we see this chart, the visitor arrivals year on year is up 15.3%, but it's still 14% below pre-COVID levels. So we're expecting it to be around 10%, the full year 2024 levels to be about 10% below pre-COVID levels, and we expect a full recovery in 2025. And for the RevPAR, we noted that despite April having lesser events or major events, like in March they had a massive Taylor Swift concert. In April they only had Bruno Mars, and Bruno Mars also didn't get much foreign demand as compared to Taylor Swift. So despite that, the lineup in April, there's still a 2.8% growth in RevPAR, so that's a good sign in our opinion. Occupancy is relatively flat year on year, but the hotel average room rates are still very high, way higher than pre-COVID levels. So right now, the hotel RevPAR is 18% above pre-COVID levels already. So the kicker is still the return of Chinese travelers. So year on year, the return of Chinese travelers more than doubled, and it's still about 20% below pre-COVID levels. So there's still some room for it to return to pre-COVID levels, and we think this will gradually improve the return of Chinese travelers, and that will help with the international visitor arrivals, as well as next slide please, as well as the retail spending. Yeah, so the improvement in international visitor arrivals and population growth will help with retail spending, and despite this chart showing that April RSI is down 4.5%, we think the retail sales will remain resilient for the rest of the year because there's several government handouts that's upcoming, and also the fact that a lot of the retail REITs, the first quarter, they came in very high positive rental reversions that surprised us on the upside. So like suburban malls had high single digit rental reversions, while the downtown malls had teens to even 20% positive rental reversions. So that is a good sign, and that's why we favor retail as well. Yeah, next slide please. And lastly, this is our coverage, and this coverage list excludes OUE, which just got initiated by Meow Meow. So yeah, we will add that in to this chart the next REIT monthly. Yeah, so that's all for me. I have time to Paul now. Thanks.
Yeah, thanks, Darren. I'll just move on to the usual Singapore Weekly. Oh, okay. So in terms of the key macro highlights on Singapore, we had the RMC demand. So RMC is really mixed concrete. Usually, those wet cement that you see being carried by those trucks that always block the road, always traffic jam. But anyway, those trucks where they are mixing the cement. So in general, that's really mixed concrete. So the building materials in Singapore continue to be very strong. In April, ready mixed concrete was 21%. Of course, the numbers can be very volatile. So when we look at the year-to-date April, it's still very strong, about 13%, and compared to last year's 5%. So you should expect some, if this momentum continues, you should expect some strong numbers coming out, at least for the first half results for Pan United and Hong Leong Asia, because Hong Leong Asia also has RMC, but they also have cement in Malaysia and also some Chinese company. So the performance will be a bit diluted. So the pure play here would be a Pan United. Then steel bars also had another strong number, 66 year to date 40. So another strong numbers coming out should be for BRC. The momentum continue. What is weak has been property. So private residential, excluding executive condo, we exclude executive condo because executive condo is very volatile. So just to get a clearer view of the trend, we took out executive condo. Then it is down 80%. So property is, these numbers are basically means the property sales is in the doldrums. It's like down 50%. Last year was already weak. Then this year it continues to decelerate 48%. We'll show a chart later, and then I'll just give an update. I did speak to some companies and to explain why it is so. So in terms of exports, we actually quite flattish, but actually electronics export bounced very strongly, 22. US retail sales, so just to get a sense of the US consumer spending, excluding motor vehicle, because again, motor vehicle is very volatile, it's still flattish. It's still, I wouldn't say it's very strong, but it is resilient, I guess 2.5. We took out motor vehicle and gas because, gas is affected by pump prices. So we took that out. It's also quite stable. So everything is subdued, but it's still holding up in terms of US retail sales. Next slide. So in terms of our tactical views, of course, this coming week, I think on Thursday, there will be a presidential debate. So that's why we just bring this topic up again. So every week, we will issue our weekly strategy in our morning note and also on P3. So for Trump, what will be his likely? Of course, if Biden is re-elected, then there's no change, also nothing to talk about. But in terms of if Trump were to be elected, for what has been known so far, of course, a lot of it is political uh, campaigning noise. But if you can try to kind of find out some of the key themes that he's been repeating, economic policies at least. So number one, we're probably going to see tax cuts under Trump. His view, at least his rationale for tax cut, is that it actually can cause more investment and instead of bringing down government revenue, can actually grow government revenue because it will create jobs, it will create growth. Agree or not, but again, that's his rationale. The second important policy for him is he's going to impose import tariffs. So his view is that import tariffs will also cause economic gain because more investments in the US, but also it's actually, the interesting one is that it's a tool for political leverage. So in a way, countries that don't behave well, he can actually impose a tariff. Again, this is the rationale. Then number three, he also mentioned that the US dollar status is very critical. And we cannot be lost because what he sees is that, like, the US has such a strong oil production resource. Why not use it? It can also reduce inflation because oil supply goes up. And of course, it can also reduce government debt because it can stimulate the economy and so forth. Sorry, my internet. So in terms of what is the market impact, having talked so much, but one possible thing is that the market reaction is that on expectations that inflation would rise. Whether or not inflation rises doesn't really matter. Most important is the what the market expects. So this could actually trigger higher bond yields. I mean, if he does get elected, sectors that could get hurt is the renewable sector and of course European exports. Because when he said he's going to impose higher tariffs, it's not just on China, which is a done deal, it's going to be increased, but it's also on EU because what he believes is reciprocal, because he says that the EU imposed high tariffs on the US, but US doesn't do the same, so they should do the same. The biggest risk for Singapore equities will be tariffs on Southeast Asia. So I don't think Southeast Asian countries impose a lot of tariffs on US goods, but what it could mean is that if you don't behave, I guess, lack of a better word, and you're too skewed towards China, especially countries like Vietnam, maybe they could impose tariffs on Vietnam for political reasons, so that you get, so that you should sway more towards the US. Again, this is all speculation. I mean, so let's take it for what it's worth. In terms of the sectors, like we highlighted earlier, the weak property is going to be negative for property developers, can be your Frasers Property, CDL, and for agencies like PropNex and even APAC Realty. Strong building materials will be good for PenU and BLC. I mean, based on the the indicators that we've seen. In terms of the events, you notice a lot of names here, like MDAD, or this. So these are all the FOMC voting members. So usually every week there's going to be a lot of Fed members talking about, some are important, some are just ignore them. So those who are not on the FOMC that will decide on the interest rate, those can ignore. So those that we pay attention, like all these they are the voting members. Of course, the key is Jerome Powell and the vice chairman. Yeah. Then there'll be US bank stress test. The other thing, semicon will be Micron to see. And also President Elizabeth. The important one will be in green, which is the US PCE. So this is again the inflation gauge that the Federal Reserve uses, and their target is 2%. The market estimate is 2% year on year. There'll be one US listed company bringing a presentation, but I think they're based out of Singapore. There's a REIT. So if you're interested, feel free to dial in. It's open to everyone. We also have Singapore strategy, then Pacific Radiance, and US strategy. Next slide. Okay, so these are the building materials. You can see, ignore the 141 because it was down 90%, then anything will, of course, be multiple times, the chart on the left. Then, okay, so for the property, you will notice that the property is now trading, that means new launches excluding exactly condo on the 12 months. That means what you do is you take the 12 months sales and then you see how is it trending. You'll notice that it's back to almost global financial crisis level. So we are trending now at 5,000 units. Speaking to some companies, what they're saying is that there's a bit of delay in getting approval for the new launch. So sales has been weak because there's been lack of new launches and there's a lot of delay. And this could be one of the reasons why there was no bid for the recent land sales, because if you have a ABSD, that means you have to sell everything by 5 years, and usually it takes 9 months to get approval. Now it's stretched to more than 1 year, so you probably have only like a maybe 3-year plus or less than 4-year window to sell. So I guess a lot of developers view this as very risky. So this delay is one of the reasons that I like a new launch. Next slide. Then move on. Okay, so this is just to show you, on the left is just to show the countries which has the biggest trade surplus with the US. Of course, from the US point of view, it's a deficit, so you see the negative number. So China is there. I mean, China is always there, always the biggest. But what you see is that EU, ASEAN, so these are the ones that could be at risk if Trump were to impose tariffs. Again, this is all speculation. Whether it happens, nobody knows. But the one on the right is just to show you that if the light shaded area shows that China's trade surplus with the US continued to grow as much as 400 billion. Then when the trade war happened, all the tariffs, you can notice it totally dropped. The bounce is, of course, during the pandemic. But the countries that I guess one way is that benefited from the China tariffs is the EU, in green. You can see that the line continues to grow. And of course, ASEAN. So mainly actually Vietnam. I put in Malaysia here because a lot of Singapore electronic companies have plants in Malaysia. So they may not be so at risk, but Vietnam's the one that should be a bit more careful who they align to, I guess, because they have such a huge deficit, 100 billion trade surplus with the US. So this is trade, excluding this goods deficit or trade. Next slide. Oh, okay, so this is my last slide. So there was a Thai beverage on Friday. I didn't do a report because I thought there was anything new, but this is their annual information meeting where they will have a meeting with shareholders to give an update, and they also have a separate meeting with fund managers and also with analysts. So I'll just share with you some of the key highlights. The main question asked was beer co. So for those who know, just to dial back, so ThaiBev had plans to do an IPO of their beer operations in Thailand and in Vietnam, which is the listed Sabeco or Saigon Brewery. So their comment is that, I think you can read from there, they still want to unlock value because they want to reduce the leverage because they borrowed a lot in 2017 to make this purchase. They can either sell it by an IPO or trade sale. So they did mention that there are partners interested. They have limited presence. So you can narrow it down. It's either the Chinese brewers or the Japanese brewers that might be interested. It could be Chinese. Is only going to be happening next year. So the conversation or the questions then shifted to Fraser's property. So sorry, my internet connection is a bit unstable. Is that so? They have a 28% stake in Thai beverage. In Fraser's property. Thai beverage has. So they said that Fraser's property is not strategic, and they want to look for a right time to divest, but they cannot divest now because it's below book. And property companies are always going to be below book anyway. So one thing this is our own guess, they could maybe distribute in specie, if possible, the Fraser's property. I think that could be one solution. That means they just give out all the shares that they own Fraser's property to all the existing Thai beverage shareholders. The one that took, then in terms of VN, which is Vietnam, the share price took a knock because the authorities in Vietnam said they want to raise the consumption tax to 65 to 100% by 2030. Another way cheaper beer, that down trading. They will pass on the higher tax, but to them, Vietnam is still the youngest market and it's one of the fastest growing beer market in the world. Okay, then for spirits business, that they said there was a record profit and they're trying to grow white spirits to appeal to the younger consumers. So you can think of white spirits like vodka, people, they drink with mixers and so forth. So the outlook, okay, so in terms of outlook, you look at the table on the left, our point here is that since the pandemic, compared to pre-pandemic, the growth for Thai bank has been really slow. I think they've been hit by regulations because in Vietnam, apart from this higher tax that's going to be imposed, there was also drink driving rules where you must have zero alcohol in your blood, basically. Otherwise, you're going to be fined. So then of course the weak macro conditions and so forth. So that's why this stock has derated. It used to trade at 18 times, now it's trading at 12 times. Unless you see strong growth, then this re-rating might stay, a derating, sorry. And what you need is that you need to have a stake sale. I think if they can do any of this beer co or Frasers property, then that could be the re-rating that is needed. But before that, I think the low teens valuation might persist until you see a big bounce. Apologies to everyone. I think I understand that I'm getting cut in and out. Yeah, my apologies for that. Yeah. The price there is not the 47 cents. There is the last traded price. We have a buy recommendation. I think our target price is 60 plus. And yeah, I need to get back to that question later. I think that's it for us. I think we can move on to Q&A. Again, apologies for the poor connection.
Let me take on some of the questions first. Someone asked about an update for some of the REITs as well as Marco Polo Marine. So I'll just briefly go on Marco Polo Marine first. Yeah, basically they released their first half earnings. It was a 10% year-on-year growth in their revenue, and also PATMI also increased by 31% year-on-year. And I think this is mainly within expectations, as considering the seasonal impact of the monsoon season. So their gross profit margin also increased, mainly driven by the charter rates, the higher charter rates of the offshore support vessels or OSVs. For their ship chartering segment, it also rose about 34% year-on-year, and mainly due to the higher average charter rates for their, as I mentioned earlier, the offshore support vessels, OSVs. Mostly by the increased demand from both the offshore oil and gas as well as renewable sectors. For the shipyard segment, it declined by around 9%, but mainly due to the lower ship repair volume resulting from the resumption of Chinese shipyard operations. But their shipbuilding activities did grow, and they are now operating at a higher average utilization rate of around 89% compared to 79% in the year before. They also do expect that the ship repair volumes will recover as the impact of the China shipyards reopening stabilizes. So lastly, for their CSOV, or their commissioning service operation vessels, their new CSOV is approximately 69% complete as of the 31st March, so as of the first quarter of the year, and they're scheduled to begin operations in October of this year. And it will be deployed under their Vestas framework agreement, which is starting in Taiwan. So they also see the demand for the large capacity vessels like their CSOVs increasing, especially with the growth of offshore wind projects. Hope that's sufficient for Marco Polo Marine. I will now go on to several questions on Great Eastern. Firstly, can we still hold Great Eastern after delist? Yes, you can. So you'll be like holding on to a private company, but then you have to take note also that you won't be able to sell off this share unless OCBC or there's another offer for Great Eastern. I think there's another related question, is that whether or not you'll still be able to get dividends. Yes, you'll still be able to get dividends. I think you can think of it similar to income, NTUC Income or Income Insurance, which they are now named that. So before they had their liquidity program, right? You could still hold on to their stock, but you just couldn't sell it off. Yeah, and you still get your dividends. Secondly, another question is that a related question on Singapore's insurance industry, besides GE and NTUC Income's major shareholding is also selling. What is the takeaway, if any? I don't think there will be really much change to the Singapore's insurance industry. If anything, what OCBC is doing with Great Eastern is that they are trying to streamline, Great Eastern's sort of goals, right? Together with their one OCBC group, which is what they are continuing to call it. Yeah, so that might be, it might come up with maybe more products or better price products. So if anything, where did my question? The industry might actually improve from this. But it's really hard to tell. I guess we just have to wait and see for this. Another question is, want to better understand better what exactly is a scenario when OCBC will make an exit offer to shareholders. Could you quickly repeat? Yeah, sure thing. Let me go back to the slide. Sen Yao, could you go back to that slide, my last slide on the OCBC and GE? Yeah, then I can just go through the second scenario. So I think the second scenario is really what is probably the most confusing one, and also really, in my opinion, about what is highly likely will happen. So basically, we just look at it as they need to have 90% of the shares that they do not own. So 90% of the 11+%, right? If they do not get that, but they still go above 90% total shareholdings, which means they only need to get 13.5% of the minority shareholders to accept the offer, which they're very, very close now. They are 89 point something percent. So they need about 1% of the 11 point something percent. So they are really very close to that. If they do get that, and they go above 90% of total shareholdings of GE, which means that the free float falls below 10%. What will happen is that Great Eastern trading will be suspended and Great Eastern will be delisted. But for OCBC, they will have to give an exit offer that is in quoted fair and reasonable, right? And fair and reasonable again means it based on the Ernst & Young's valuation of what is fair and reasonable would be a range of $28.87 to $36.19. Right, so this could be an offer that they could exit offer that they could give if it falls into this second scenario where less than 90% of the minority shareholders accept the offer, but at least 13.5% of them accept. So if 13.5% to 89.999% accept this offer of $25.60, then it will fall into this second scenario where they will have to give an exit offer. So looking back, in the past, what is similar would be with Boosted, where I mentioned earlier also that they had the same scenario where they had to give an exit offer, and they had their previous offer, their first original offer was also deemed not fair but reasonable, right? So they had to push up the exit offer to make it fair, basically. And similarly with OCBC, if they fall in this second scenario, they will have to push it from $25.60 to at least $28.87. At least is deemed by Ernst & Young to be fair. Yeah, hope that clarifies and you'll be able to understand. Okay, another one is, how do you see AIA as buying AIA as a replacement to holding Great Eastern for insurance stock? I mean, it is also an insurance company. It's a lot bigger than Great Eastern, right? So, but of course, there are a lot more diversified geographically, at least compared to Great Eastern. So if you really want to get another insurance stock, you could possibly get OCBC, because now if they do acquire successfully fully own Great Eastern, then you will be buying a bank plus an insurance arm as well, right? So OCBC is also will be looking, you get it as a sort of two-in-one, basically a bank and an insurance arm. Okay, another one. Hi Glenn, can you share what influence GE will have on OCBC futures business? Your perspective on the complete acquisition of Great Eastern as a good catalyst to boost share price. Yeah, definitely. So the influence that Great Eastern will have on OCBC's future business is really not so much quantitative as it is qualitative. They mentioned like 0.2% increase in the ROE, but I think if you look at it as a whole, right, it's really about how they can streamline and have more control over Great Eastern to be able to flow and synergize better with OCBC. Right, so GE will probably be able to sell or come up with products that are more in line with the ability to cross-sell into OCBC's maybe wealth management or fee products. So that's the possibility where we see OCBC will be heading towards. And I think that's the main goal that they have with trying to fully acquire Great Eastern. Okay, so it keeps skipping to the questions. Yeah. So my perspective is that Great Eastern could be a good catalyst to boost share price, but it really depends on how OCBC is able to synergize Great Eastern well, because they currently already own majority of it, right? They have 89%, and they also have, they can make the management decisions as to what GE does. So if they own 100%, will there be really a big difference as to how Great Eastern can change, or how much can it change basically to fit into OCBC's their one group idea or strategy? Okay, now I think this is quite related to what my question was earlier, so I will skip this. Will OCBC stock perform better after acquiring Great Eastern? I think it'll take some time. It won't be immediate. You know, it's not like with DBS and UOB, right? When they did the acquisition for the city assets, it was I would say it was an inorganic growth, right? Where they pumped it into different countries where they're trying to grow, and you could see immediately the effect that they had. You know, like you could see increase in their AUM, the assets under management. You could see increase in their card fees. You could see increase in their loan book as well. But with Great Eastern, you know, they just put in an additional 11%. So you won't see that increase automatically with their AUM or even their insurance income. So it really be how they change Great Eastern. I think it'll take some time. It won't be immediate. It's really more of a medium term to long term play rather than a short term boost to their earnings or even their growth. I think there's one or two more. Let me check. Do you think OCBC will pay special dividends if they are successful in GE's acquisition? I really hope so. Apart from, you know, if you're talking about OCBC wise, they do really have a very high CET1, capital equity tier 1 ratio, and that is the base for a bank to see how much they can acquire and how much they can pay. So even if they do this acquisition of Great Eastern, their CET1 is currently at 15.6%. It's still, you know, at least about 1 percentage points higher than the other two banks, right? And they have increased their, at least DBS has increased their dividends, and they're willing to pay higher. But for OCBC, they are really very silent on whether or not they can pay dividends. And they mentioned also in their last results briefing that they're going to maintain at least 50% dividend payout ratio. So it'd be quite shocking to see if they suddenly, you know, successful in acquiring GE, and they spend about that minimum, they spend 1.4 billion, right, to acquire Great Eastern, and they suddenly put in more money to give back to shareholders. So I think it'll be a good surprise if they do give a special dividends or to increase dividends after they do this acquisition successfully. But they definitely have the buffer to do it. That's to say that they can do it. It's whether or not they want to or not. Will GE's acquisition be accretive to OCBC after near-term or mid-term earnings? Like I said earlier, I think it will be, it's 0.1, it's only 0.2% to the group's ROE, right? So it's really quite minimal. As I mentioned earlier also, you know, it's really more of a mid-term to longer term play where they will try to synergize Great Eastern into their overall group strategy, and then they can you know, implement new products or change how the focus of Great Eastern goes to in the future. So it's really more of a longer term play, I would say, for OCBC. Oh yeah, I said earlier also whether another question is, will OCBC CET1 drop after the Great Eastern acquisition? Yes, it will drop by 0.6 percentage points. So it will drop to 15.3%, sorry. DBS is at 14.7 and UOB is at 13.9% now. So they are still much higher, you know, than their peers, basically. Yeah. So they have that buffer to give out higher dividends, right? They have the buffer to give out special dividends. But whether or not they will do it so soon after spending such a huge amount of their capital, you know, they have not really increased their dividends that much, at least according to the last 2 years, right? So it's really hard to say whether or not they will further increase their dividends going forward. I think that is all for me. Let me just run through again. Yep, I think that's all for me. I'll hand it over to the rest of my colleagues. Yeah, thanks. Hope it's clear enough. If any other questions, you can just put it into the chat and I'll try to answer. Thanks.
Yeah, thanks,
I guess
Ben.
I'll take over. Oh, sorry. You go first.
Yeah, let me take a few questions here. Your views for Tesla, ARM, AMD, and NVIDIA. So I'll start with Tesla first. In terms of Tesla as an EV company, we are still a little bit, I guess, more bearish because there's so much pricing pressures and volume pressures, a lot of competition from Chinese EV makers. The upside, I guess, longer term, is their ability to roll out their full self-driving in China. And they keep saying that they want to be, I guess, valued more as a software company. But that's probably at least, I want to say 3 to 5 years down. If you're talking about near term as an EV company, car manufacturer, margins compress, pricing compress, not really that much upside as of. When you look at the other three companies, ARM, AMD, and NVIDIA, they basically fall in the same category of fabless chip designers. And so obviously with this whole big AI momentum going on, we still are quite bullish on at least AMD and NVIDIA. We don't cover ARM, but similarly for ARM, with this whole upcycling of mobile as well as PCs, should send a benefit because just more units coming up, more units being produced, more units being sold. So definitely, bullish on those three. Tesla maybe not so much. Now I'll take this other question that's meant for Paul. Hi Paul, what is your view for the US market since last week was a small correction? Still bullish now, especially for AI stocks, NVIDIA, AMD. Yeah, so overall, fundamentally, the earnings is actually improving quite significantly for a lot of US companies. The only, I guess, negative thing we see is that valuations are getting a little bit stretched, which is it's not the be all and end all. Obviously, as long as earnings can support it, market can still go up. It's just that I think right now S&P is trading for 22, 23 times, or 21 times forward PE, which is quite a lot compared to its average of closer to 15. So it's a little bit stretched on from that perspective, but at the same time, earnings are improving for a lot of companies. So if you talk about near term, let's say in the month of July coming up, likely because it's earnings season about to begin towards the end of July, we probably start to be a bit more bullish, I guess, during earnings season. Right now it's a bit of a lull. There's not much news going on. So yeah, maybe probably nothing going on for the next few weeks. I would expect. Yeah, I hope that helps. I mean, it's almost impossible to predict the market, especially in such the near term. But I guess the main gist is that earnings fundamentals are actually improving. Plus, if the Fed starts to cut rates earlier than expected, or it just starts to cut rate in general, while overall economic conditions continue to improve, then there will just be more catalysts for the market to go higher. Yeah, I think that's all for me. Maybe hand it to Helen to continue on. Thank you.
Thanks, John. There's one that asked to flash the first slide on the S-REIT. So Shayao, can you help? And that one's not really a question. There's another question on Apple. What is your long-term target price for Apple since the impact for its AI plan recently announced is likely to be multi-years? I'm assuming your target price of 220 is for the next 12 months. Okay, for our target price, our target price is actually a 12 months target price. We don't do long-term target price as if you buy a share now, almost 100% you will make money in 10 years time. So they're not very much value add. But with that being said, it doesn't mean our target price is only for the 12 months. It does not take into consideration of the effects in the future years. So the way we do our target price is that we will forecast the numbers for the future years and then discount it back and add them together to come up with a target price. So if a news, it only affect the current year, we will adjust the current year number accordingly. But if it will affect multiple years to come, we will adjust our forecast for the multiple years ahead as well, and then discount it back. So rest assured that the AI effect is fully incorporated into our calculation. And you're right, it will definitely impact the future years. First is that it will trigger a new round of replacement cycle because it has been really long that iPhone does not have a replacement cycle. I mean, the first few series of iPhone coming out, every time a new one come out, there's a lot of new features that everyone was like, oh, I wanted to buy the new version. But recently, all the new iPhone coming out, people kind of already lost track, but because there's not really the need to like get a new one. So finally, this is something revolutionary. It's giving people a big reason to upgrade their iPhone to keep up with the trend. And additionally, because Apple is already losing its market share in the phone market, so this is definitely something that can potentially give them a boost in their competitiveness. So if iPhone intelligence really takes off and offers a lot of convenience and transform our life, we'll definitely start seeing other phone users slowly switching to iPhone as well. So yes, it will definitely impact for multiple years ahead. So with all that incorporated, we came up with a target price of $220. So I hope that answers your question. I'll pass my time to the rest of my colleagues.
Hi, I'll take the OUE question. Sorry, let me put it up. Also, distribution for OUE rate always come in three parts: capital distribution, taxable income, tax exempt, and taxable. I assume capital distribution is from the divestment gain. Tax exempt is from the rental income. How about taxable income? Yeah, so taxable income include like three parts. The first one is property rent and related income from OUE Bayfront property, but not the gain from disposal of the property. And secondly is Singapore South interest income from placement of surplus cash as disposed in the bank. And the third one is rental top-up payments arising from the income support arrangement. I'll post it in the chat later, like answer your question in the chat. And the next one. There's an OUE question. Yeah, are you not concerned about a bad reputation of Lippo Group historical track record for OUE rate? Yeah, so we are aware of the adverse effect brought by Lippo Group. Yeah, but reputational risk is not quantifiable, so we never, so factor into the model. But we assume it's already reflected in the current share price, like the high discount to NAV of 0.43 times price to NAV. Yeah, so the risk, which was already like imposing some monetary impact on the group is income risk brought by Lippo Plaza. The effect on OUE rate at group level is very marginal since like Lippo Plaza only accounts for 7.7% of the total income. And among the 7.7%, only office side is seeing negative rental reversion. Yeah, so the actual effect on the group's top line is really like not very significant. We're only looking at around like 3% of the exposure to Lippo Plaza. Yeah, hope it answers your question. And there's another question on CapitaLand Escort Trust and Far East Hospitality REIT. Which one is more preferred? Yeah, so it's not an apple-to-apple comparison as the two REITs differ like very much in terms of the market cap and also its geographic exposure. Far East Hospitality Trust is a pure play Singapore REIT, and Class is very like geographically diversified. So for Class, we expect like RevPAR to continue trending up in FY24, especially France is having their like Olympics. Yeah, so we expect RevPAR to doing well in 2024. And they also have like 3 million divestment gain from the previous divestment, which will be used to buffer against the downtime from AEI. So they'll be like topping up distribution. Compared to Class, some metrics for Far East Hospitality Trust, which we believe they're outperforming Class, is their gearing is very low at 31.5%. And their valuation will be very stable given all the assets are based in Singapore. So the demand and supply are very stable. Majority of the new supply are from the luxury end of the hotels, and Far East is only like upscale or yeah. And RevPAR is expected to continue trending up since Singapore is expected to have around like 19 million international visitors in FY24. And they also have 18 million divestment gain from Central Square to buffer against like any macroeconomic uncertainty. So we'll be using to top up DPU with a target dividend yield of around 6%. Yeah, so we have a buy recommendation for both two REITs. There's no preference on which one you should choose exactly, and it really depends on your risk appetite and your investment needs. Hope it answers your question. Thank you. I'll hand over to the rest of my colleagues.
Yeah, thanks, Mel. Yeah, I'll answer some. Any update on Premier Street? Yeah, so Premier Street, no updates, which is obviously a bad thing because we want the update that they will that they have completed their refinancing of the 69% of the total loans, which is due July 2024, end of next month. So they are basically running a little short on time. So they did mention, the management did mention to us that they believe they're already in the final stages and they believe that it will be done by end of June. So end of June only left 1 week, so we are still waiting for that. And yeah, hopefully they'll be able to refinance this 69% of their loans, which is due basically next month really. And yeah, if they don't, then they'll probably be in a default situation, and yeah, that will be a disaster. So yeah, hopefully we're just waiting for the good news that the management is so confident that they will be able to refinance. So the reasons that they are confident, I believe I shared it in the past. So one of it is because the banks, the loans, the lenders rather are from America. The US banks, Bank of America actually is a syndicate led by Bank of America. So they are more comfortable with financing US commercial real estate at about a 65% loan to value, as compared to Singapore, where Singapore REITs, where they have the gearing cap of 50%. So Singapore banks, they're comfortable with an LTV of around 40%. Yeah, and also prime assets, they are also still generating cash flows and they've not fully defaulted. So yeah, those are some of the reasons why management is still confident that they will be able to complete this acquisition. Sorry, what acquisition? They'll complete this refinancing. Yeah, so that's the update for Prime. Hopefully we receive the update that they've completed their refinancing. And once we believe that once if they come out with that news, we believe the share price will react positively. And yeah, actually in our report we have two target price. One is 0.12, which is basically the price is trading at now, and the other one is once they refinance, we believe that their target price, our target price will jump to 0.18, which is 0.3 times price to NAV. Yeah, so that's an update from Premier Street. Any update on ESL logos? Yeah, so ESL logos, no update also since their quarterly business update. Yeah, but some things that I can mention are that Singapore logistics are still doing quite good. The demand is coming from third-party logistics as well as pharmaceuticals. But the thing about industrials in Singapore is that we are expecting the rental reversions to drop because during COVID, logistics, they had this e-commerce boom demand and such. So the rental reversions were 20% like for multiple quarters, in fact, dragging on and dragged on for a few years. So, but we cannot expect this 20% reversions to keep continuing until forever. So we expect this year to drop to single digits really. Yeah, so that is just an update. Any reason for share price weakness in Capital and Sandal Street? Yeah, I don't see any specific reason why Capital and Sandal Street share price is weak, but basically I see the whole REIT index, or rather after the FOMC meeting, it all reacted negatively rather. So the share price was weak after the meeting that they came out and said was probably just one rate cut based on the summary of economic projections. Yeah, so that is not a good sign because remember at the start of the year, the market was already pricing in 5-6 rate cuts as compared to 1 to 2 now. So yeah, that's a bad sign. But we believe the immediate catalyst will definitely just be the rate cuts for REITs. So yeah, do you see this as a good opportunity to buy in more shares? Yeah, we do not cover, so we do not have a target price for CapitaLand and S-REIT. And unfortunately, Zane is not here today, so we'll be able to do TA. So I can't really tell you when is a good time to buy the shares. Yeah. Thanks for the question, though. Hope that clarifies. What is your view on Sabana REIT? Yeah, so Sabana REIT, I didn't really follow much, but I know the most recent thing is that they tried to issue a bond, but Quartz Capital, they came out and said that they had some control clause where if they issue this bond, then it'll be harder for them to carry on with the internalization process. So they are going back and forth with this. Yeah, so it is very yeah. I don't really have a view on that for Sabana REIT because this internalization thing is it's going back and forth between Quartz and ESR. So yeah, I can't really comment on that. Sorry about that. When is a safe price to buy into CDL? Yeah, so for CDL right now, they are trading at our RNAV is 1250. So right now the share price at about 530 is over 50% discount to our RNAV. But we believe it's still a value play because it's trading at such a steep discount. But we do know that there are catalysts, that there's a lack of catalysts. Like right now, the ABSD is 60% of foreigners, and then it's hard to sell out their core central region. Like the Newport Residences, they tried to launch it, but they got delayed as well, and they failed to launch it. It's delayed more than 1 year already. So yeah, that's the main headwind, which is the property, like Paul mentioned as well earlier in his slides. So yeah, we believe we need a catalyst for it for the price to recover sharply. Yeah, but we do have a buy recommendation. Yeah, I have a target price of 6. Sorry, let me just slip my mind what target price is. Yeah, target price is $6.87. Yeah. Yeah, but I do know it's a 12-month target price. So for near term is in our view, there's still a lack of catalyst. Yeah, I think that's all for me. I'll hand over time to Paul, maybe. Yeah, thanks.
Okay, thanks, Darren. So I'll move on to some questions. So the question from Mr. Ang. Hi, Paul. Understand that you have stopped covering Asian pay TV, but are you aware of any possible reasons for the continuous drop in share price? So there could be 3 things. Firstly, I think by December they did a write-off on their assets of I think 400 million. So that kind of shook investor confidence. Secondly, the more recent has been the rise in the TIBOR or the Taiwan short-term interest rates. It used to be only 1%. I mean, amazingly, it went up to 1.6%. Still very low, but it's probably going to hurt their interest costs as they refinance again in 2025. The third reason is probably just the operationally, although broadband is doing well, but their pay TV is still sliding. So operationally, so in conclusion, we still think they can. So they are paying a 1 cent dividend. They committed for this year about 14% yield. There is still room to maintain it because if you do some back of the envelope calculation, they generate maybe cash flow, maybe 120, 130. interest, let's say 40, 50 million, then capex 30, 40 million. So you're talking about 80 million. So they are left with probably about 40, 50 million. So, sorry, I will just put the video off. So even though they have about, let's say about 40, 50 million to pay dividends, that will their dividend about 20 million. So they still have room to pay, even with the higher interest rate, 1 billion, you add in another 50 basis points, you're talking about only, or one full basis point, you're talking about, sorry, 25 basis points, you're probably talking about 2.5 or 5 million. So they still have room to pay dividend. But I think is the reason why we had a buy last time, which I think we had like lots of complaints, which is mainly was because at the time they were paying like 8% interest rate, and rates were, of course, then there was a zero interest rate environment. So we were banking that there is a good risk reward because they were paying like 8% yield and the interest rate environment was low. So that was the main thing. But once interest rate started to climb, then of course the whole thesis just broke down. Thanks for that. Hi Paul, Valuetronic trading halt, any news? Okay, I can only guess. Again, I'm also blind, but maybe I got like half an eye that can see what might be possible. So we think there could be two. Again, this is guess, a 99.99% guess. We checked just now whether they've ever made any trading halt. So Valuetronics in the whole history never made any trading halt. But they want two possible things. So firstly, they mentioned before that they want to buy back shares more aggressively. But because the volume is so thin, then they cannot be like more than 1/3 of the volume. So one possible thing they could do is do an equal access. So if you look at OUE, so OUE made an equal access offer. Well, it was the anniversary, but anyway, the mechanics is that the company just give an equal access, maybe 10% of all shares or whatsoever at a certain high price, and everybody just sells that to them. That's one scenario. The second scenario, of course, privatization. Their EV EBITDA is only like 2x. The only pushback against the privatization is why now? Okay, maybe because they're turning around. But secondly, is they always said that being listed has its merits because they do compensate staff with share options. And secondly, being listed does help with customers. So when customers see them being listed, they got a transparency of their results, everything. So customers have greater confidence in giving them orders. So they did mention this before. So again, I only have half an eye, so I'm not really sure which is which. But if I had to guess, it could be an equal access offer again, because they want to do more aggressive share buyback, because they've been talking about buyback, but they hardly do anything because there's no volume. Okay, next one. Hi Paul, is Thai Bev very poor share performance has a strong correlation with the poor performance of the stock exchange of Thailand and Thai baht? Yeah, that is so. Like you heard us mention before, I think Thailand is probably the worst performer in Asia, worse than China, which is quite a tall order. I mean, to have a performance was mainly because the growth has been slow. So GDP, I mean, just to give you a flavor, is only 1.5% up in the first quarter, and is below expectation. So the poor macro conditions has been one of the reasons for the weak performance of Thai Bev. Because the whole economy has been rather weaker than expected. So that's one of the reasons too. Hi, at how many standard deviations is Straits Times Index trading now? What are the significance of this? So it is, so the average PE is about 14x. Is trading below one standard deviation. I don't have the chart here. Next time I'll show it to you. But it's trading now about 10x PE. The significance is that by statistically, usually it shouldn't trade at this. It's usually 4 or 5% in a normal distribution. I don't know, 5% of the time it only, or 2.5% of the time it only trades this way. And usually it should revert to the mean, but I don't know, this is theory. Just like CDL trading at 60% discount to book. I mean, it should also revert to mean, but no problem is that I think the whole Singapore market has been derated. I mean, to be blunt about it. So unless we have some sovereign money coming back in or something, then not clear whether this one standard deviation minus standard deviation can go back to mean. Yeah. Do you predict another big bull run should Trump be elected, just like the first successful election? I think it's possible because he measures the success of his campaign by the stock market too. So I think if you recall in 2018, 2019, in his Twitter account, he always, whenever the stock market hits a new high, he will always tweets it out. So at least I guess it's comforting to have a president that has the stock market is his KPI, or this is internal KPI. I mean, this is as good as I can say. I mean, yeah, I mean, not that I have any insight into what he's thinking. Yeah, but generally, I think that's the again, it's just about expectations. Reality is one thing, but if everybody expect the stock market to run, then no, you just trade along with it, whether it's reality or not. No, but that has been. But you're right. I mean, what Mr. KY said, that there has been his thing that he always talked about the stock market during his term as president. Hi Paul, what are your thoughts going forward for Keppel? More positive results. Okay. One visible thing is that if you recall, I think Sembcorp Industries mentioned that in the first half of this year, they're going to have huge maintenance in their power plant. So 2 of their power plants out of the 4, I think, is going to be down. So Keppel's results, I mean, Sembcorp results won't be good. That's probably obvious in the first half. Because their plant shut down, then they have to buy power from other producers. So that could help Keppel. But again, the thesis for Keppel is more asset disposals. So they are looking to sell 4 billion of their assets, which is some of the REITs that they sold. And another, I think, if I have the number in front of me, about 11 billion of other assets. So Keppel is, the thesis for Keppel is just one more run. I mean, once they sell, after that, then I think it's done. I mean, one more and done, I guess. Once they can sell their assets, that's how we are coming at. So they have another 12 billion of assets they want to sell, which is data center, M1, infrastructure. So if that can happen the next 12 months, then I think that's it. I mean, more or less it, because operationally, I don't think there's anything outstanding for Keppel, because they are still trying to build up their asset under management, which will take a long time. So that's why we still have a buy. Accumulate with target price of 798 is mainly because of this one more cycle of asset disposals. Paul, Thai Bev, buy rating, what is the target price? Our target price is 63 cents. But I guess that we worry. I mean, we will try. Our thesis for it was that their valuations can go back up to 16 times PE. But I think without anything happening, unless the earnings recover strongly, it's going to be quite challenging to hit back the 16 times PE. Oh, okay. What do you think of the trading halt of electronics? Yeah, I think we mentioned it earlier. I can only say it should be good news. I mean, it can't be like bad news again to a trading halt. Although they never done one, but again, fingers crossed. It can only be good news. Yeah. Any target price for moment? Yeah. So sorry, we don't have coverage. Zane is not in. So apologies. So he'll be around next week, so you can ask him for that. Yeah. Yeah. What is the TA? Again, Zane is on leave. So so from Monday onwards, he'll be in, and you can ask him for all this TA. Hi Paul, what is the re-rating catalyst from stake sale for Thai Bev? Can you elaborate more on this? Okay, so again, stocks can get a re-rating. That means the investors get more positive because assuming they can get a good valuation for Beer Co. Because since the stock now is trading at 12 times, so if they can get anything more than 12 times, which you can assume is quite reasonable, then there can be a re-rating in the valuations. Then, this stock actually should be valued more, and then they can get proceeds from it and deleverage. That means they will get some money by selling it to maybe a Chinese brewer, which I'm just making it up. And then they can get the money and then lower their interest expense. So that's what we mean by re-catalyst. Likewise, they can get a re-rating catalyst if they sell Fraser's property, which most investors, I think most of the investors, sum of parts, like my target price includes a 20% discount a 20% discount to their stake, their 28% stake in Fraser's property. So if they do distribute the shares, then maybe there's some realization of value. Of course, the risk is that when there's so many shares coming out, then the share price of Fraser's could drop even more. But there could also be a cash alternative. So maybe, I'm just guessing here, maybe Fraser's property might do a cash alternative whereby you can, instead of taking shares, you can sell your shares to Fraser's property at a cash alternative. Again, I'm just making all these things up. That's one possibility. Because you don't want so many shares to come out, every minority will just dump the shares, and the shares are going to drop back anyway. So kind of defeats the purpose. What's your outlook for Wilmar? Okay, I probably every week I'm going to repeat the same thing. So no, those who heard it for don't know the 200 times, so just bear with it. We think the outlook is going to be quite sluggish or flattish because of the key divisions, like edible oil, consumer, and also soy crushing, where they sell the meal to hog farmers. Those are just quite sluggish because the Chinese consumer not strong. Palm oil plantation is just going sideways because it's trading at a premium over soy, so the price can't really move much. And then the third part, which is refining of oil, is going to be a bit soft because Indonesia has too much refining capacity built up during the pandemic. So for us, Wilmar is going to be quite sluggish in the near term. Yeah. What are the key drivers? What are the factors? Mr. Kevan asking, what are the factors that keep driving Singtel share price going up higher? Is it too overbought now, technically and fundamentally? Yeah, okay. So we have a buy on Singtel. So we think what's going up is, number one, their yield now is attractive at 6%. Of course, part of the yield includes some like interim special, but this interim special could last 3 to 5 years. So I think people just take it as normal. I mean, so they're paying a quite attractive yield now. And then number two, operationally things are getting better because they're starting to cut costs in Optus. And also you're beginning to see their other operations of associate mobile that they hold like in India and so forth starting to improve. And then thirdly, there's expectations that they might sell some more assets. Can be India, can be Thailand, can be anywhere. I mean, that's what they said. Which could actually, then they will pay back out a special dividend. Yeah, and that could realize the value, because although my target price is I think $3 plus, if you just if you mark to market the value of their stake in the associates, that means the share price, which we really give like I think 30% discount, is worth more than $3. It's probably like 3 plus to almost $4. So that's why. And in this environment where and usually tactically people buy telcos is when growth is not so robust. So probably there could be some tactical shift towards a defensive sector. Hi Paul, year to date, private residential is down 48% and negative on PropNex and CD development roughly. What would be a good time and price to buy? Okay, so you have to buy, you have to believe that private property shouldn't be so low. I mean, based on the number of people coming into Singapore, population growth. So if you assume steady state demand should be 6,000 a year, then you probably need to wait until the bad results flush out in the first half and then assume that there will be a recovery, because so many developers are waiting to launch their projects. So then there should be a bounce in the new launches. And you have to make the assumption that 5,000 is too low, that there is an intrinsic demand. Like we showed you in the chart earlier, not Sanya, you can show the annual demand is actually 11,000, historical demand for new units. So now we are trading at 5,000. Of course, it's very expensive now, 2,000 per square feet. But if you assume that demand shouldn't be so low, then maybe that's a good time. But you probably need to wait until the bad results is out. But of course, if you're very bearish and you think 2,000 what is going to buy, then it's different. Yeah, but okay, okay. Quite a lot of question here. Then okay, what's the outlook for Nano Film, Food Empire, Wilmar? Okay, I answered Wilmar. Do you think the share price will deteriorate further? Any drivers? Okay, so for Wilmar, for Nano Film, I think it's going to be quite challenging. The only saving grace in the near term is really Apple. So unless you really see iPhone sales start to pick up, because Apple or customer Z is their biggest customer, until then, I think it's going to be quite challenging. The one main catalyst they're supposed to get is there's two catalysts that could happen for nanofilm. Firstly is that they are supposed to do the bus, that means coating of some of the EV batteries for a Chinese customer, but with what's happening and replace electroplating. But because of what's happening in China, I think that's not going to happen because that is not the bottleneck. So that will be out in the near term. The third one is they secured a new customer. We guess it could be Samsung for their new phones. But the good thing is that, of course, it's Samsung, and they're not just coating the iPhone, the buttons and so on. They're actually coating the whole enclosure. But the problem is this is only for one model, and if you assume they are a second source, so the volume could still be thinner. But I mean, it's a good progress. So it just takes time for nanofilm. It's not like totally horrible and everything, just that you have to assume that iPhone sales can rebound, like what Helena mentioned, and then they, apart from Samsung launch more titanium type models, they will need more of their coating. So the good thing is that they're not just coating the buttons, they're coating the whole enclosures. But my only pushback to all this is that, I mean, if they always promote themselves as deep tech, right? But if you're deep tech, why are you second source? I mean, that's my only pushback on using the word deep tech. Deep tech means you're the number one source and your margin is super high. Because you are deep tech, right? You're the only guy that can supply. But anyway, let's not go there. Yeah. Food Empire, probably the earnings is going to be weak because of the high coffee prices. But Food Empire has a very good habit of passing on the cost. So you might get a temporary weakness in margins, but because of their strong market share and brand share in Ukraine, Vietnam, and so forth, they can actually just raise price, but it will come with a lag. Why Yang Zhejiang went up non-stop? Okay, Yang Zhejiang, so Mr. Jeffrey Chan asked why Yang Zhejiang share price went up non-stop because container prices surged up 60% last year. I think so far, last month. This month, I think it's up another 20-30% because if you saw the news, the Red Sea just experienced another attack, and they're now talking about 10,000, back to the post-pandemic high of 10,000 in terms of freight rates. Container freight rates. It was, I think, 7,000. I haven't checked the latest number now, but it could go back up. The speculation is to go back up to the 10,000 high again. So that's why, and yeah. Why Mermaid also went up with no oil price up? I'm not sure actually. I need to get back to you, Mr. Chan said. Yeah, sorry, I don't have the answer. Probably not. Yeah. Is there any website that can track May dividends for Singapore stocks other than going to individual stocks? So, I know current dividends can be found using. Yeah, I don't have the answer to that. Oh, yeah, actually, I don't have the number to that. Yeah. I don't have it. Yeah, we in our morning note, we're trying to incorporate some of these up. So it's still a project that we're trying to do. Bank stocks, I leave it. Where is Yoma stock heading? Yoma stock is probably like double in the last few months. I think if the macro is still stable, then they should still perform well because they are still enjoying very strong property sales. This is as much as I can say. Yeah. Because when the stock got QE, they mentioned our report, which is, although it's non-rated. Yeah. Citron big down due to legal cases. Is this the knee-jerk reaction? I think not only that, I think the other negative news for Citron was that I think they sold some yachts which were at a very disappointing price. I don't have the number ahead, but I think that was the other thing, because after the merger, they were supposed to sell some of the old yachts and get a good price, but I think the pricing for that was below expectations. Yeah, I don't have the number offhand, but that was one of the reasons. But I think I'll show you a chart next time or during our Singapore strategy. There's still another 4 more FPSOs coming up from Brazil. So that should give them some momentum. Yeah. Although they got a $11 billion contract, but the share price still down. I so scratch my head. Yeah. Okay, I'll leave it to Meow, and then I think I'll leave it to the rest for the share price. Yeah.
Thanks, Paul. Maybe I'll just take these first 2 questions here. So Mr. Jeffrey Chan asked, is Great Eastern worthwhile to continue holding? I think you have really hit the nail on the head with this comment. I think that's what everyone's trying to ask, or trying to at least get the information for. So you look at Great Eastern, you look at that dividend yield. So if you continue holding Great Eastern, and if it's delisted, which is highly likely, what happens is that you will still get your dividends, right? But their dividends, even if at the upside, right, the highest point, they're looking to pay 80 cents, 40 cents per half, so 80 cents per year. And at the current price of $25.60, that's the offer price that OCBC gave. It's only around, I think, 3.1%, right, dividend yield. But on the negatives, you are not able to trade the share because it's now delisted. So you really can't sell it. You just collect the dividends and hope that in the future there's another offer for the remaining shares if it's at this state now, right? So what if you ask me, if you want to get some exposure to an insurance stock, but be able to collect dividends and also be able to trade the shares, then you can just go to OCBC, because they really do own majority of Great Eastern anyway. You can collect dividends of almost double, 6% plus, right? And you'll be able to trade the shares. Yeah. So I think if you ask me, it's not really worthwhile, in my opinion at least, to continue holding Great Eastern. You can just hold OCBC and still have exposure to Great Eastern. Okay, bank stocks are now high. Mr. Pua asks, bank stocks are now high, especially DBS. Do you think it's reached its peak? How about UOB Bank? Thanks. Yes, I don't think it's reached its peak yet, because the growth is still going on, right? For the banks, even DBS, all the banks, right? The growth is still going on, and the growth, as I mentioned, previously in all my other presentations, is that the growth is not coming from the net interest income anymore, right? Because interest rates have peaked and they are now kind of like just stagnating at these levels. So what they are pivoting towards is now the fee income, where the investor sentiment is moving on to more of a risk-on approach, and they're also putting more of their deposits as well as their funds into wealth management products. And hence you can see that there's huge growth, double-digit growth in fee income, which is what they will be supporting their earnings growth. So if it's supporting the earnings growth, the banks will also be able to continue to continue to grow their dividends. While the other two banks have kept their dividend payout ratio at 50%, but they said that if earnings do continue to grow, and they do expect dividends to grow, earnings to grow, then dividends will also grow in line with their earnings growth. For DBS, it's a different story. They will be continuing to give back more to the shareholders, which is why the DBS has performed slightly better than the other two. For UOB, I think they're really banking on their city acquisitions. They are expanding more into the region because for them, at least, Singapore has seen quite muted growth in their loans portfolio, especially their SME side, right? Because they're SME bank. So as again, they also maintain their dividend payout ratio of 50%, but they do see some growth in fee income as well as in the rest of ASEAN, where they are really expanding into their city acquisitions for the rest of ASEAN, like Thailand, Indonesia, Vietnam. I think that's all. I'll hand it over to the rest of my colleagues. Thanks.
Thank you, Glenn. I'll take over the 17Life question. Ever since your bad recommendation of 17Life, the share price has been dropping like a rock. What's wrong with it? Yeah, so the plunge of the share price has been happening since the market changed the expectation of rate cut. Yeah, originally at the beginning of the year was like 5 or 6. Yeah, so it changed to 3 rate cut, and now like the market only forecasts 1 rate cut by the end of this year. So we believe it's more of the macro factor that has been impacting on the company. But fundamentally they're doing okay. There's 3 initiatives for them in FY24. The first one is cost cutting, and the second one is grow revenue for VLabor, and also to grow MAU. Yeah, for 17Life, their cost cutting is very much on track. Like there's 15 million cost saving from the R&D expense, and so far has all been done. And they have also finished the revenue cutting for the revenue sharing for their streamers. Yeah, so this will like substantially save their cost. And yeah, and they have also been expanding revenue contribution from VLabor. And so one skin used to cost like 3,000 per skin, and takes like weeks to generate one skin. But now it's like they have around like 3,000 skin for free, and it's like readily to be used for the streamers. So this will attract a lot of the VLabor streamers and to increase their revenue contribution from VLabors. Yeah, so like all the initiatives are doing well, are well on track. Yeah, we are probably meeting 17Life next week, and we'll update on the next webinar. Yeah, hope it answers your question. Thank you.
I think there's one more on the banks. I think you meant, do we expect OCBC and UOB to follow DBS on giving quarterly dividends instead of half yearly? I highly doubt they will do that. DBS, they gave it in 2005, if I'm not wrong. And then 2005 to 2009, they gave quarterly dividends. Then they stopped it in 2010, all the way until 2019. So 2019, they restarted giving quarterly dividends. So if DBS has been doing this for so long, yet the other two banks did not want to give it, so I don't think we will expect to see them changing to this quarterly dividend instead of just continuing with their half-yearly dividend payments. Yeah, so I doubt we will see them changing just because DBS is doing it. Yeah, if anything, we hope that they will just give more dividends like what DBS is doing. Yeah, hope that answers the question. Thanks.
Darren?
Yeah. There's a question on Capital D REIT. I believe you're asking for any updates. Yeah. So for Capital D REIT, there's no update. The share price. If I remember correctly, the question is whether the share price will stagnate. So I believe if there's any good news that is regarding the China Guangdong data center tenant. So let's say if they pay or if they manage to replace the tenant and there's little downtime, then definitely there will be some upside potential immediate in the near term. But other than that, I believe there won't be much share price appreciation potential because there's still this headwind of the non-collection of rental income from the Chinese tenants at the Guangdong data center. Yeah, so other than that, no updates for Capital D REIT. Thanks.
Glenn.
Yeah, so we don't cover iFast. We don't really have a target price for iFast. I won't be able to answer that. But for iFast, mainly it's just they're looking at see how they can really incorporate their global bank, because what's driving their growth now is really their Hong Kong e-pension business. Yep. So if the global bank can their banking can actually go and become positive, right? Then we should see further growth for iFast. So for SGX, SGX wise, yes, share price is not. Sorry, what's the outlook on SGX? And also share price has not moved much, hovering below $9.50. So for outlook for SGX, it will be their the OTC FX business has been the main growth contributor. So this comprises of their BitFX, Max Trader, as well as the ECN, which is the Electronic Communication Network. It has actually grown quite fast, and also they're on track to reach their full year FY25 average daily volume target of $100 billion. Right, for the first half of FY24, it was at 100.1 billion. So it's really well on track to reach that target which they have set. I think we have seen also, looking at the SGX statistics, that both the securities daily average volume as well as the derivatives daily average volume, so the SDAV as well as the DDAV, has been moving positively and growing year on year. So we should see that also contribute positively to SGX. I will do probably next time around, I will do a bit more details into those two figures and how we can expect and what's the outlook for SGX going into their full year FY24 results. Yeah, so I'll do that for the next round. Thanks. I think that's all the questions. Maybe back to you, Paul.
Yeah, okay, thanks. So we just last one here. Mr. Ang, during his term, Trump always been pressuring Powell to cut rates. Yeah, but Powell didn't really bother. Instead, Powell actually raised rates during his term. Yeah, it's so high compared to So there's always speculation that he might, because Powell's term ends in May 2026. So there's always speculation he might want to replace him. But it's not easy because you read that Wall Street Journal article is replacing a Fed is like replacing a Supreme Court member. So it's probably not likely. There's possibility they might want to demote him, not be the chair. So, but regardless what happens, anything that if Trump keeps on badgering and it could actually spook the bond market. So it could again also push interest rates up. Again, sometimes he just have to play on the expectations of what he does, not even what he actually can do. Yeah. So if he keeps on threatening he wants to intervene, then there could be threat that it will spook the bond markets, I mean, in general, because there'll be a Federal Reserve that doesn't really care about inflation, just want to lower rates. Yeah. Yeah, but I mean, thanks for that, Mr. Ang. Okay. Daiwa REIT. Okay, I will give my 5 cents worth of what I think the problem for Daiwa REIT, the one that shocked me the most was that even though their occupancy was 99% or I don't know 99.9, they still cannot raise rents, because in Japan it's very not common to raise rents. So I mean our joke was that like you probably need like 110% occupancy before you can raise rents. So yeah, but anyway, I'm handing over to you, Darren or Miao. Yeah, I think you're mute. I think I can't hear. Yeah, sorry.
Hello, can you hear me now?
Yes,
Sorry.
yeah.
Yeah. So for Daiwa, the good thing about them is that their assets are in Japan, so their loans are also based in Japan, so they're getting much lower interest costs than other REITs where they have properties outside. So for them, their all-in interest costs, despite the talks of the Bank of Japan still increasing the rates, but their all-in interest costs for this year and perhaps next year will likely cap at 2%. So they are likely to go higher than that. So they'll still benefit from this. Yeah, but for growth potential wise, yeah, pause, right? It's hard for them to renegotiate positive rental reversions, as well as they do not have the base rents, they do not have any escalation also. Yeah, so it's really flat for them. Yeah, thanks. Yeah, I think that's all. I hand it back to you, Paul.
Yeah, thanks. Yeah, actually, we were looking at then, but we figured their asset could be the loans was the asset, not so much the asset, because the loans were so cheap. But the value of this so-called asset is diminishing because interest rates are rising. Okay, but anyway, thanks everyone for your time, and also especially for your questions. I hope it was useful, and I hope to see you next week. And I wish everyone have a great week ahead. And thanks everyone, and take care. Thank you.